How does the process of purchasing a home loan under an LLC work? Do they still run an individual's social security number, or do they use an LLC EIN?
The vast majority of traditional lenders will use the EIN, and then you'll have to issue a personal guarantee unless you've built up a relationship with that financial institution and have significant credit history under the LLC. But I would not be worried about a PG, a personal guarantee. It does not hit your credit unless you default at the business level of that loan. An LLC is eligible to acquire property through traditional financing. The terminology is called conventional loan, right? That's the phraseology that's used. But there are also other loan types. There's a really good loan type called a DSCR. That loan type is designed to be focused on the property itself, not on the purchaser. Meaning, when they do all of their analysis, they're still going to look at the purchaser's credit and things of that nature, but that's not heavily weighted. What is heavily weighted is what is the income that is currently being derived from that asset that's being acquired, meaning it's already rented, what its current rent roll is. A DSCR loan will take into account the rent of the property up to 75%, meaning 75% of the rental income can be used to qualify for the loan, which is huge. That gives you the ability to acquire a property without sharing your own personal tax returns, not having to pass onerous credit standards, right? You still have to have a reasonable credit, but it doesn't have to be like off the charts. You can have credit that has a 5 in the beginning of the number. You can have credits in the 5s and still qualify for DSCR loan. It's better to qualify in the 6s, but you don't need it in order to qualify. Now, one of the things I would say is that you'd want to make sure that you'd work with a qualified mortgage broker or a mortgage professional in general, a loan professional in general, because I like the concept of leveraging people's skill sets, but there are differences too. You need to understand that different loan programs have different interest rates that are associated with them, and that's always going to be based on the risk that the lender is taking. The more risk the lender is taking, the more the interest rate is. So if you think about the DSCR loan as an example, the bank, the lender, or the financer is actually taking more risk. Why? Because all they're looking at is the property, and the property could go untenanted. Maybe there's a challenge with the tenant. So interest rates on DSCR loans tend to be more expensive than traditional financing, like conventional loans. But again, go back to my commentary just a little while ago with regard to the difference between amortized interest and compound interest, because it may cost, yes. But again, I did this YouTube video, it's going to be published pretty soon, where I did a side-by-side using the same interest rates, and the numbers are off the charts. As an example, I'm going to make it really rough here because, again, I don't have the numbers in front of me, but let's say you acquired, let's say, a $400,000 property over the course of 30 years at 4%. That may cost you somewhere around $170,000 to $190,000 of just interest component. So yes, you're paying way more for the property over time because of all the interest that accumulates. And the numbers that I'm sharing here may be incorrect because I don't have the mortgage calculator in front of me, but when compared to compound interest that you would receive for using that capital to acquire income and then compounding that income over time, the actual net worth accretion that you achieve by doing that far outpaces the cost of the interest. The other thing to remember is the cost of the interest for any type of business-related activity, which real estate for investment purposes consider business-related. That cost of that interest is also tax deductible. These are all things that you want to factor into your decision-making process. But again, overall, the process of utilizing an LLC to acquire a property is absolutely justifiable. There are other approaches though as well. You could go the individual approach to do what's called house hacking. House hacking has two general approaches. One is within one unit, you're house hacking through room hacking, right? Renting out rooms. Within multifamily units of 4 units or less, you could get things like an FHA loan or a VA loan if you qualify for a VA loan, and live in one unit and rent out the others, and that's perfectly fine. When you're using an FHA loan, you're only required to live in it for 1 year, well, 12 months from origination. Once that 12-month mark works out, you can get a second FHA loan as long as you qualify. You have to qualify for a larger down payment for the second one. You have to have income in order to justify it, but they utilize and they will allow the utilization of the other unit income in order to help support the qualification for that type of loan. You can move out of the first multifamily, rent out that unit, and then move into the second multifamily in year 2, and now you have multiple units. And in year 3, what we've counseled and worked with a lot of clients on in year 3 is now they identify a personal residence that they want to personally utilize, and then their goal is to move out of the multifamily environment and then use the income from the multifamily units that they own to now support the single family residence that they live in. That whole process success is pretty remarkable. I know it's a long-winded answer again to your question, but I wanted to, again, make sure that I fully flesh out the concept.